In a few days, the Fed will be ending its QT program. Investors are celebrating, partially because it's assumed that the next step will be QE, and that will be bullish for the markets, right? Well, not exactly. The effects of QE and QT are not as clear-cut as commentators make them seem, and we have yet to see anyone provide a simple yet comprehensive explanation of how these operations affect markets. And that's why today we're going to be explaining what QE and QT are in simple terms, including exactly how they affect the markets and why. My name is Nick, and if you have any investments, this is a video you can't afford to miss. Before we begin, you need to know that I am not a financial advisor and nothing in this video should be considered financial or investment advice. It's educational content intended to inform you about QE and QT. If plain English explanations of complex financial topics are something you enjoy, then hit that like button and be sure to subscribe to the channel and ping that notification bell so you don't miss the next video. Now, let's start with QE. QE is short for quantitative easing, and contrary to popular belief, it does not involve printing money, at least not in the classical sense. QE is when a central bank like the Federal Reserve, aka the Fed, purchases financial assets and usually government bonds. The purpose of these purchases is to increase the amount of money in the financial system, and we'll explain how a bit later. First, though, you need to know that the Fed does not purchase these assets directly because it's technically not allowed to. Instead, it purchases these assets from so-called primary dealers, which is a technical term for financial institutions like banks. In practical terms, then, QE is when the Fed purchases assets from a financial institution. But this begs the question of where the money used to fund these purchases actually comes from. And the short answer is bank reserves, which is kind of like credit on a credit card. When the Fed does QE, it basically creates new credit out of thin air and then uses this new credit to buy assets. Of course, the difference is that the Fed doesn't need to repay this credit because that money isn't owed to anyone. As such, you can think of bank reserves as credit on a credit card that doesn't ever need to be repaid. Welcome to the modern financial system. Anyways, to quickly recap. QE is when a central bank purchases assets, usually government bonds, from financial institutions, usually banks, using money that it credits to its own account out of thin air. So, no, physical currency isn't printed, but yes, the supply of money in circulation increases similarly to how you would have more money if your credit card balance was suddenly increased by your bank. And this ties into the other side of the equation, which is QT. QT stands for quantitative tightening, and contrary to popular belief, it does not involve destroying money or even selling assets, at least not directly. And to understand why, we need to understand bonds. Imagine you lent the US government $1,000. The Treasury Department would give you a piece of paper promising to pay you back in 10 years plus interest. Congratulations, you are now the proud owner of a freshly printed 10-year US Treasury bond. And there are a few things you can do with this bond, namely selling it to other investors, using it as collateral at a bank to borrow money, or just waiting for the bond to mature, i.e. for the full repayment to happen in 10 years. And if you happen to be a central bank, then your default option is to wait until the full repayment. And this is where things get interesting. Under normal conditions, central banks will roll over their bond holdings when the bonds mature. In other words, when they get their full repayment for holding a bond, they will use the repaid money to buy more bonds, typically the same type and same duration. Believe it or not, but QT is when a central bank merely stops using these fully repaid funds to buy as many bonds. And this seemingly harmless act of central banks deciding not to reinvest repaid money back into bonds can cause asset markets to fall. Just two more things to note before we dig into these dynamics. And the first is that when central banks sell the assets they purchased, this also counts as QT. And that's because QT practically refers to a reduction in the central bank's balance sheet, a decline in its asset holdings. And the second thing to note is that the Fed tries to make sure that its balance sheet isn't too big, but also isn't too small. And what's funny is that nobody knows exactly what the ideal balance sheet size is, but most estimates put it at 22 to 24% of US GDP. With US GDP currently being around $29 trillion, the Fed's ideal balance sheet size is somewhere around $6 to $7 trillion, and it's around $6.5 trillion at the time of shooting. So, to recap, QE is when central banks purchase assets, usually US government bonds, from financial institutions which increase their balance sheet, i.e. their asset holdings. On the flip side, QT is when central banks either allow the bonds on their balance sheets to mature and do not reinvest these repayments into new bonds, or when they sell these bonds on the market, reducing the size of their balance sheet. And now that we understand the basics of QE and QT, we can dig into the dynamics that cause the markets to rise and fall because of these central bank balance sheet changes. Remember our hypothetical scenario where you lent $1,000 to the US government and got a 10-year Treasury bond in return? Well, you'll recall there are a few things you can do with that bond. Sell it, use it as collateral, or hold it to maturity. And as we've learned, central banks almost always hold their bonds to maturity until the money is fully repaid. However, this is not the case for almost all other market participants in the financial markets. Individuals and institutions will frequently buy and sell bonds and use them as collateral to borrow more money. That's right, using debt as collateral to take on more debt. Again, welcome to the modern financial system. Anyhow, like any other asset, the price of a bond depends on supply and demand. If the supply of a bond rises while the demand stays the same or decreases, then the price of the bond will fall. Conversely, if the supply of a bond falls while the demand stays the same or increases, then the price of the bond will rise. And what makes bonds different from other assets is the relationship between bond prices and bond yields. When bond prices fall, the yield on that bond will rise. And when bond prices rise, the yield on that bond will fall. And you can think of the bond yield as being the interest rate on the money that's going to be repaid when the bond matures. And this is a fitting way to think about it because bond yields on government debt have a direct impact on the interest rates for other forms of debt in the economy. For example, if the yield on a 10-year US Treasury bond is 4%, then the interest rate on other long-term debts in the economy, like mortgage rates, will be slightly higher, around 5 to 6%. And that's because lending to the US government is the lowest risk form of lending. Every other kind of lending carries a higher risk, hence the higher interest rate paid as a credit spread. But the key takeaway is that bond yields determine interest rates elsewhere. So, suppose that the Fed buys a bunch of US bonds as part of QE. Logically, this increases the demand for US bonds, and this means that the price of US bonds rises. In turn, this means that the yield on US bonds falls, and the result is that interest rates for other kinds of lending in the economy fall too. And this makes it easier for individuals and institutions to borrow, which results in more economic growth and investment. And that's just one of the stimulative effects of QE. In case you forgot, there's another thing that participants in the financial markets will do with these bonds, and that is to use them as collateral to borrow more money. And this means that when US bond prices rise because of QE, it becomes possible to borrow more money against US bonds because the value of the collateral has risen. And this also results in more growth and investment. As you might have guessed, some of the extra money that's borrowed because of falling interest rates and rising bond prices gets reinvested into other assets like stocks and real estate, causing their prices to rise. What you might not have guessed, though, is that lots of investors also borrow against stocks and real estate too. So when the price of these assets rise, it results in even more borrowing, growth, and investment. But wait, there's more. Bond yields don't just affect interest rates in the economy, they also affect the value of the respective currency. For instance, if US bond yields fall, the US dollar's value will fall relative to other currencies, all else being equal. And because most of the world's debt is denominated in US dollars, a fall in US dollar means that it becomes easier for individuals and institutions to pay down their dollar debts. The practical effect of all of this is that they have more money left over to invest in other assets around the margins, which also increases economic growth and investment on a global scale. Not only that, but falling bond yields also make other assets more attractive to investors. And this results in capital moving further down the risk curve in search of higher yields. And that's exactly how you end up with a massive AI bubble. Say, if you're looking to buy assets, then check out the Coin Bureau Deals page. That's where we have numerous deals and bonuses on various financial platforms exclusively sourced for the viewers of this channel. And you can find those deals by scanning the QR code over here or hitting the link in the description. They won't last forever, so take advantage of them ASAP. So when you understand all of the different ways that QE boosts the amount of money in the financial system, you realize how powerful it is in stimulating the economy and the markets, especially when it's the Fed that's doing QE. But obviously, the exact opposite of these dynamics occurs when there's QT. What's not so obvious, though, are the mechanics by which these dynamics occur, particularly at the start of the QT process. To quickly recap, QT is when the bonds that central banks hold are fully repaid, and they do not use this money to purchase new bonds. Again, this sounds seemingly harmless, but it can have a profound impact on the markets. For starters, the fact that, say, the Fed is no longer buying as many US bonds means that other investors need to step in to buy these bonds, or else prices will fall and yields will rise. Now, what's fascinating is that there is money sitting elsewhere at the Fed that can step in to buy the bonds that the Fed would have normally bought but isn't buying because of QT. The Overnight Reverse Repo Facility, or ONRRP, is one spot where this money can be found. And if the name sounds familiar, that's because money from the ONRRP was used to offset the Fed's QT between 2022 and 2024. What makes the money at the ONRRP so fascinating is that it technically exists outside of the financial system. It is literally money that is sitting beneath the Fed's couch cushions, waiting to be found and spent if needed. And if you're wondering where this money comes from, the short explanation is financial institutions which keep their money at the Fed, either due to regulations or safety reasons. In any case, what this means then is that QT by central banks like the Fed can have zero negative impact on the markets and the economy so long as there's extra money lying around somewhere like the ONRRP that can be used to buy the bonds that the central bank is no longer buying. But if these facilities are empty, then the money needs to come from elsewhere, and that's where the big problems begin. To quickly refresh your memory, when bond yields fall, bond investors will move their money elsewhere in search for yields, in search of bonds with higher interest rates that have relatively low risk. For the sake of simplicity, yields are the most important thing to the pools of capital that invest primarily in bonds. And that means that if you want these pools of capital to buy your bonds, you need to increase the yields. And, well, that's exactly what the bond markets will do. It will raise the yields on the newly issued bonds to attract more bond buyers to make up for the shortfall in demand left by the central bank doing QT. Unlike the Fed, these bond buyers can't just create money out of thin air to buy these bonds. They must sell something else to buy the bonds, and that's typically other bonds and assets used in yield strategies. The act of selling other assets causes the value of those other assets to fall, which means that anyone borrowing against those assets suddenly needs to sell something to pay back their debts. And since government bonds are the primary form of collateral, these bonds get sold and their yields rise. In turn, the rise in government bond yields makes existing debts more expensive and makes it harder to borrow. The practical effect of this is that all the money that's created by all the different kinds of borrowing enabled by QE suddenly needs to be repaid. The result is that economic growth turns into economic contraction and investment turns into divestment. Individuals and institutions cutting back on spending and selling assets to pay down their debts. And this causes even more economic contraction and divestment. And if it happens to be the Fed that's doing QT, then the resulting rise in bond yields will cause the US dollar to strengthen against other currencies. And since most of the world's debt is denominated in US dollars, a more expensive US dollar means that individuals and institutions around the world with US dollar debts must sell other assets and currencies for US dollars around the margins to keep up. And that, ladies and gentlemen, is precisely why everyone always talks about how the Fed's QT can and arguably will break something in the global economy or the markets. It's just because it results in a complete reversal of the stimulative effects of QE, effects so complex and so nuanced that not even central banks fully understand them. What we explained in today's video just scratches the surface. So, to quickly recap, QE stimulates the economy and the markets in multiple ways, including lower interest rates, more borrowing against various forms of collateral, and a weaker US dollar in the case of the Fed QE, all of which results in an increase in the amount of money supply. On the flip side, QT causes a drag on the economy and the markets as it reverses the stimulative effects of QE in ways that not even central banks understand. And this begs the question of what happens when something in the global economy or the markets breaks because of QT by the central banks. And the short answer is more QE. The longer answer is something that deserves its own section because it will be extremely relevant during the next financial crisis. You see, the whole time we've been talking about QE and QT as if they only involve government bonds. In reality, QE and QT have involved other similar kinds of debt, including mortgage-backed securities, corporate bonds, bond ETFs, and even junk bonds and commercial paper, which can be simply understood as some of the riskiest bonds in the entire financial system. More importantly, the size and scope of assets central banks have purchased has expanded significantly with each financial crisis. During the 2008 financial crisis, major central banks like the Fed and the European Central Bank only bought government bonds and bonds related to the assets that were causing the financial crisis, specifically bonds related to housing and bonds related to banks, respectively. During the 2020 pandemic, however, the Fed and ECB opened Pandora's box by buying corporate debt and ETFs. And the reason why they did this was essentially because everything was crashing and they didn't know where they needed to provide liquidity, where they needed to inject that money. It wasn't clear whether buying government bonds would be enough because maybe the private sector was the one in need. And this underscores my earlier point about how central banks don't always know where the problem is. And this also highlights something we mentioned in our video about private credit. And that's that credit issues in the financial system have become so complex that when the next financial crisis inevitably comes around, it will be impossible to know where central banks need to inject that money. And this means they only have one option, and that's to go even further, buying everything until everything stabilizes. And this sounds crazy until you realize there is precedent for this. Back in 2020, the Bank of Japan, or BOJ, became the first and only central bank to start buying stock indices and real estate investment trusts. As a fun fact, many macro analysts believe the policies the BOJ used in the past will be used by other central banks in the future, especially since the Fed played a role in the BOJ's unprecedented QE. No, this is not a conspiracy theory. Former Fed Chairman Ben Bernanke is widely recognized as having played an instrumental role in shaping the BOJ's policy, including the purchase of stocks and real estate. If you want a conspiracy theory, consider that former Japanese President Shinzo Abe was assassinated while writing his memoir, which was expected to include information about how Bernanke advised him on the BOJ's policy. But when the memoir was published after Shinzo's death, it contained no mention of Bernanke's role in Abenomics, the name given to the BOJ's expansive QE policy undertaken during Shinzo's presidency. If that wasn't suspicious enough, the motive for Shinzo's assassination was his connection to a niche sect of Christianity that Shinzo's relatives were a part of, but that Shinzo has absolutely no affiliation with. Anyway, conspiracy theories aside, the fact of the matter is that central banks will have to resort to BOJ levels of QE when the next financial crisis inevitably comes around. Again, this is because the buildup of debt in the global financial system is so large and so complex that it'll be impossible to know exactly who is short on cash or how much they need. Notably, a failure to go all out with QE risks causing an even bigger crisis, and that's just because it could result in a total collapse in trust in the ability of central banks to stabilize the global financial system. And this is a scenario where hard assets that are intertwined with the global web of debt surge and everything else collapses. There's just one small problem though, and that's that almost every hard asset is intertwined with the global web of debt, whether it's gold or Bitcoin. And this means that when margins start being called, everything will be liquidated for fiat currencies, mostly US dollars. The result will be that everything crashes. But hard assets like gold and Bitcoin crash slightly less and currencies rally, especially the US dollar. But I'll repeat that this is a scenario where faith in central banks is completely lost. If that faith is maintained or restored, everything will explode higher. And that's because the unprecedented QE will result in unprecedented money creation. And that's when hard assets like Bitcoin and gold will go parabolic while currencies implode. So keep these two scenarios and these two outcomes in mind, because it looks like one of them will happen in the not too distant future. For what it's worth, we'll be right here keeping you updated every step of the way. So if you want to learn why the cost of living keeps rising and when it will come down, then you can check out our video on that right over here. And if you haven't subscribed to the channel yet, you can do that right over here. This is Nick signing off. Thank you guys very much for watching, and I'll see you again soon.